Video, we're going to walk through the journal entries for the transactions that took place in Handout 2.1. Our first transaction was a stockholder invested $10,000 in the business in exchange for common stock. Recall, assets, of course, are increased with debits, and liabilities and equity are increased with credits. The first thing we had was an increase in assets because the stockholders gave the corporation $10,000 in stock, and their claim on the assets are in the form of stockholders' equity. And again, we're going to increase assets with debits. So we debit cash for $10,000, and of course debits have to equal credits, and we're going to credit stockholders' equity or common stock for $10,000. In transaction B, the company borrows $15,000 by signing a notes payable for the bank that's due in 3 months. So the company is getting $15,000 in cash and has a $15,000 increase in liabilities. We'll of course record that increase in cash with a debit for $15,000, and the $15,000 increase in liability is increased with a credit to notes payable. So again, assets are increased with debits, and liabilities and equity are increased with credits. And of course, the opposite is true. Assets are decreased with debits, and liabilities and equity are decreased with debits. Assets are decreased with credits. All right, we receive and pay $20,000 of equipment. So we've got equipment, an asset, increasing, and we have another asset, cash, decreasing. So we will record the increase in equipment with a $15,000, or rather a $20,000 debit to equipment, and the decrease in assets is recorded with a $20,000 credit to cash. In transaction D, we purchase $300 of supplies on account. So we have an increase in an asset, supplies, and an increase in accounts payable, which is a liability. We'll record the increase in supplies with a $300 debit, and we will record the increase in liabilities or accounts payable with a $300 credit. Transaction E, we sign a contract for website design for $10,000. Recall, we have no transaction at this point in time because there's been no change in assets, liabilities, or equity. We won't owe the $10,000 until the website designer performs the service. All right, in F, we pay $300 to the supplier. In D, recall we had our accounts payable for the supplies we purchased. Now we're going to pay for those supplies. So we'll have a decrease in cash and a decrease in accounts payable. We decrease assets with credits, and we decrease liabilities with debits. So we debit accounts payable for $300, and we credit cash for $300. Let's go ahead and take a look at transaction G. We purchase and pay for $600 worth of supplies. So we're going to have an increase in supplies, which is an asset, and we'll have a decrease in another asset, which is cash. So we will debit supplies for $600, and we will decrease assets, decrease cash, with a $600 credit to cash. Item H, we purchase and pay for equipment costing $1,000. We have an increase in equipment, which is an asset, something we own, and we're going to pay for that by decreasing cash. So we will debit equipment for $1,000 to increase an asset, and credit cash for $1,000 to decrease an asset. And in I, we order a lawnmower, a $900 lawnmower, to be delivered next month. Again, we've just placed an order. We haven't received the lawnmower yet, so there's no change in our assets and liabilities or equity, and we do not have a transaction.